Our next speaker is Joe Kaderavek. Mr. Kaderavek is CEO of Cobalt Blue Holdings, a cobalt-focused mining development company which was incorporated in 2016 for the express purpose of developing the Thakaringa Cobalt project in New South Wales. Mr. Kaderavek is an aerospace engineer who commenced his career as a RAAF engineering officer before transitioning to PwC, where he was responsible for operational reviews and examining strategic options across mining, processing, railway, and port facilities globally. He has 7 years of operational experience in large open-cut mining operations and associated logistics. Over the last 15 years, he's been involved in equities investment research, focusing on mining, minerals, processing, and energy storage technologies. Mr. Kaderavek also held an international consulting role focused upon renewable energy and battery storage technologies. The floor is yours.
Thank you, Tony, and good afternoon all. For those I've not met, my name is Joe Kaderavek. I'm the CEO of Cobalt Blue. It's my privilege to be here today to articulate the Cobalt Blue mission, talk about the cobalt market, and importantly, describe to you our strategy to gain and ultimately hold share in the cobalt market. I'm not here just to merely share goals and aspirations with you. Let's talk about briefly the business structure itself. The ticker is COB, market cap around 60 million. We have net cash of just under 10 million in the bank, no debt, and management holds, or execs and board hold, around 9%. Importantly, LG, our newfound first mover partner, holds 6.1% of the book, and I'll come back and talk about that shortly. Let me share some views on the market. Look, there's a lot to take in on this slide. But fundamentally, lithium-ion as an EV battery chemistry is here to stay. No other chemistry can offer you the energy density, the affordability that lithium-ion does. The bottom Venn diagram, the three circles, is a bit complex, and I'm happy to take that offline. But effectively, within the EV space, only cobalt cathodes give you the fundamental prerequisite of affordability, performance, and scalability. A lot of chemistries look really good on the lab bench, but to scale it out to hundreds of thousands or millions of vehicles, warrant them over 6, 7, or 8, 10 years of service life, they're a long way short of that. And only the cathode chemistries give you the sweet spot of those prerequisites. Our view on the market is that the cobalt market today, and I'll just give you a quick comparison, the cobalt market today is around 100,000 tonnes of metal. You could put the entirety of the cobalt market into the whole of a Capesize bulk carrier. And whilst that comparison's a little glib, it does show some of the scarcity value in cobalt. Today, over 50% of cobalt is destined for the battery market, and the two key segments in cobalt are the oxides, which are basically the chemistries for batteries that go into screen devices, including laptops and iPads, etc., and the sulfates, which are the chemistries which do the larger batteries in heavy lifting in EVs and renewable storage. Our focus as a company is on the sulfate space. We believe it'll grow threefold or more in the next decade and present an exciting opportunity for our business. Having shown you this chart though, the key question is how we're going to get there. The Cobalt Blue Thakaringa Cobalt project has a mine to battery integrated strategy. We are an integrated mine and refinery. We're not there to clip 20 to 30 cents in the dollar of the cobalt price and sell a low value add intermediate. We're there to take all of the cobalt margin and sell a battery ready high grade cobalt sulfate product. And that strategy for us is all about capturing the entirety of the cobalt margin for the cycle itself. Now, as impressive as these type of charts are to investors, bear in mind that we're trying to break into an industry that's been around 50, 60 and 70 years. Now, we're a $2 upstart from Australia. For us to break into that chain and have the credibility to sell the product, a very high spec product, we need a partner and we need technological assistance. In March of this year, we were proud to sign LG International, as our first mover partner. LGI, for those who aren't aware, is the use of capital for the holding company, and the holding company includes LG Chem on the battery side and LG Electronics on the electronics side. That's really important to us because it meant that we suddenly have not only a source of funding potentially, but also technological assistance for which to steer our development. And the important point to make is not so much the scale of our partner and the technological proficiency, but is to say that the battery specs that we're aiming for today in 2018 aren't the point. As high as they are, as quickly evolving as they are, we're focused on the target in 3, 5 and 10 years' time. And for myself as a CEO, it's paramount that we build an integrated mine and refinery which doesn't become technologically obsolete. It's one that allows us to shoot at the moving target, and we need a big partner, a big brother to do that. And we're proud to call LGI our partner. I'll also pass on some recent feedback that my colleagues and I received on commercial visits to Asia. Despite the current swoon in the spot price in cobalt, the long-term view on the price, the long-term view on the metal balance is still very strong. There is still fundamental fears of a long-term deficit, and security of supply is paramount, both at the trading house level but also with the battery makers. The other feedback we received is cobalt is here to stay. It's baked in to the battery makers' formulas for the next 5 to 7 years. And lastly, and a point that's been well made by others before me, that purity levels for nickel sulfates, cobalt sulfates are only increasing. You aren't in the game unless you're making a sulfate that's at 1 or 2 ppm impurity across a number of metals. So that's our view on the market and our strategy. Let me introduce the project. The Thackeringha Cobalt project is 23k outside of Broken Hill. Now, if you think about mining and all the key costs line in mining, people, power, fuel, water, all the enabling costs in terms of logistics enablers such as road and rail, we have all of them at Broken Hill. We're 23k from Broken Hill. It's an established mining town, 19,000 people already there, the right skills, the right numbers to help us build and construct, but ultimately operate and maintain. Power, the gold rectangle you see there is a 220 kV substation. That's the high voltage transmission system for the eastern states. We can tap into and get wholesale power, which does all of our heavy lifting for us. Water, the New South Wales government has recently commissioned and is constructing a Murray to Broken Hill water pipe, and that will have first water through next year, which will bring another 12 gig of water to the district, of which 1.5 is available. Road, you can see the barrier highway just passing to the top of the tenement. Now that's a half an hour commute for our people to go to and from work every day from their homes. And rail, the railway passes through the top of the tenement and will be vital for us to take our co-product sulphur to market. In March of this year, we declared a major resource upgrade of 72 million tonne total, of which 52 is indicated. I think the key point here is there's 62,000 tonne of cobalt in the ground with line of sight on a multiple of that. But key for us in terms of this chart is that the cobalt is entirely held in pyrite. So you take the pyrite with you, you capture all the cobalt. And that makes our processing very, very straightforward and has led to a number of gains for us technologically over the last 6 months. And again, in the interest of time, I'm happy to take that into the booth. We declared, as part of our PFS delivered in early July, we declared a maiden reserve. Now, we converted 52 million indicated tonnes into 46 reserve. Now, that's a pretty phenomenal conversion rate of around 90%. And it shows you that as soon as we have the geological certainty to create an indicated resource, the economics are very supportive to convert into an ore reserve. And that speaks to the cost line, which again, I'll touch on shortly. These reserves were cut at $26 cobalt. And the upside production target you see there is 59 million tonnes, and in our case, a mere 13 years. It's a big corporate target for us to extend the life of mine. And if we believe we can get a 20-year life of mine out of the project, it'll materially swing the economic payback of the project. Just briefly on the PFS economics, inclusive of all contingencies, 550 million price tag, just under 3,600 tonne of metal equivalent produced per annum, and importantly, a sub $13 per pound C1 cash cost. I'll touch on that in a moment. Just under 13 years of mine life going forward, and the NPV and IR shown there, both of which are subject to the following catalysts. The next 12 months, we have 2 revenue and 2 cost out opportunities which will profoundly change the investment. Firstly is mine life. We will shortly announce to the market a major drilling campaign, which will start in late Q3, Q4. We believe that we'll have a significant resource upgrade at the back end of that. In conjunction with drill work, we'll also do some resource model optimisation. Between both of those, we'll have line of sight on a considerable multiple of today's resource. All of that data will be public by end of Q1 calendar 19, so not far away. Recoveries, we assumed a mid 85%, well, a low 85% recovery in the PFS. We've achieved 88 and aspirationally we'll target 90. Again, that's a big IR kicker and NPV kicker. Two cost out opportunities. One is power at 22% of our cost base represents a sizable target for us to compress. Optimising our load profile, the use of waste heat reclamation in our operation, as well as the use of decentralised generation such as solar will make an important contribution to us. And lastly, plant tailings, again, a large cost line, which was originally premised on a dry stack philosophy in the PFS. We're now looking at more conventional wet systems, which will allow us significant cost savings. All of those catalysts are within the next 12 months. So you have a robust project today, getting better in the next 12 months as we go forward. Let me talk to you about the cost side. Why is that sub 13 US dollars a pound important? Well, it's important simply because if you have a look at the historical cobalt price curve, which you see there some 40 years, only 1 year in the last 40 was the average, in real terms, price of cobalt below $12 a pound. So that we can say not only to equity investors, but importantly to project finance and debt providers, that there's an economic resilience in the project. We've got a large resource base, long life mine, and the economic ability to trade through even the trough of the market. And that's a really important selling point for us. This next table is very biased, and I apologise for the polymetallic cobalt players out there, but what I've tried to do here is show you the capital efficiency of our mine. In other words, what's the US dollar of capex required to produce 1 tonne of cobalt per annum? Now that's important if you're sourcing cobalt. If you're a trading house, if you're a battery industry player and you just want cobalt focus, then this metric will be front and centre of your mind. The capital efficiency of Whakaringa is around 1/3 of the peer group greenfield potential projects coming through. And that's a very profound statement, I think, when it comes to creating commercial partners and commercial relationships. And broadly speaking, 86% of our revenue is cobalt. So you're getting a lot of leverage for your buck. So let me just say in summary, and just in the interest of time, I'll wrap up by saying that Cobalt Blue is the only primary cobalt player on the ASX and one of only 2 globally. In other words, the majority of our revenue line is cobalt. We're an integrated mine refinery concept, and we want to capture the entirety of the margin through the cycle. We're a low-cost base, economically resilient project. We have globally leading low capital intensity, and we're in a safe Australian jurisdiction. So with that, I thank you for your time.
Thank you, Joe. We've got time for some questions. Are there any questions from the audience? Right up here.
Joe, is anyone else using the process that you are using, and what's been the track record?
Yeah, it's a great question. If you take the building blocks of our process, it's being used everywhere. The cons, the calcine, the leach circuit, there's a commercial application for that somewhere in the world, and extracting metal from pyrite is quite a common process globally. Gold from pyrite, copper from pyrite. We're the first to put our headspace around extracting cobalt from pyrite. So the answer to your question is yes as building blocks, but no as an entirety for cobalt. Our test work today at 1 tonne speaks for itself, but our next step is to test work over 1, 2 and 3,000 tonne of ore and make a profound statement to the investment community as a result. We're looking to get first test work in the 12-month or so time frame. I mentioned cobalt recoveries earlier, but that's our target.
Great, thank you again, Joe.
Thanks for your time.